course, it's been another busy week for the U.S. markets amid the earnings season. John Terrett walks us through the week from the New York Stock Exchange.
Well, it always is quite the week on Wall Street, and it began, if you remember, last weekend with a senior member of the board of the central bank, the Federal Reserve, Michelle Bowman, saying that she predicted more interest rate hikes coming in 2023. She said she agreed with the interest rate hike in July of 25 basis points, but she did say she wanted to see more data before finally making up her mind. That certainly garnered plenty of headlines around the world. By Thursday, it was all about CPI, the Consumer Price Index, inflation paid in the stores and the gas stations. For once, economists pretty much got it right. It came in more or less bang in line with expectations. The headline, 3.2%, but the core still far too inflated for the Federal Reserve at 4.7%. And there was a slight increase in both of those for the first time in about 13 months. However, the markets ignored it and rose anyway. Wall Street thinks that the Federal Reserve will pause when they meet next in September. On Friday morning, PPI, producer price inflation, came in on the upside. That was seen as bearish. Virgin Galactic did what it says on the tin and had its first proper tourist paying flight midweek. And Disney turned in earnings that were mixed. The shares were down 3% on the Friday session, but they were up 3% for the week. It's worth pointing out that Disney, almost every one of its divisions, is struggling somewhat at the moment. It is, in some respects, at a crossroads, leading people here to wonder whether Apple might actually take Disney over. Some people think that's a good idea, others think it's a non-starter. On the markets on Friday, well, PPI and also consumer sentiment weighed a little bit, but the Dow was up 1/3 of 1%, the Nasdaq down 0.5%, the S&P 500 down by 1/10 of 1%. The Dow was up for the week, the other two were negative for the week. And in the week to come, a very big week for retail earnings. We'll hear from Home Depot. We get retail sales figures too. We'll also hear from JD.com, Target and Walmart, among many others. John Terrett, CGTN, on the trading floor of the New York Stock Exchange.
For a closer look at the markets, Sean Stein Smith, Assistant Professor of Business, Lehman College at the City University of New York. Good to see you again, Sean. You know, if I told you that we'd have this downgrade from Moody's, inflation, we're winning, but we haven't won yet. The consumer, iffy at best. We saw a little dip in the last report just earlier today. And the markets are only off by a couple percentage points from their all-time highs. I mean, is that surprising to you?
So it really has been a very interesting last 12 to 18 or so months, right? As obviously, price inflation has been higher during that prior period than versus, any time during the last 30 to 40 years. And it really has been interesting to watch how the Fed, how companies, and how consumers have been trying to balance their outlays, right? Be it CapEx, be it travel on the individual side. It really has been interesting to watch, and I would say that overall, the outlook and the actuality right now is a cautiously optimistic outlook, which does, kind of match with the expectations going forward. That here in the U.S. at least, there has been this possibility of a economic downturn being talked about for the last 18 or so months. Hasn't quite happened yet, as companies and again individuals can pivot and can reorient how they are actually allocating capital.
I mean, I guess what I'm getting at is people on television keep talking about recession. There's no recession. So either the TV is trying to brainwash people or they're just flat out wrong, right? The consumer is relatively strong. I know we have some other issues around the world, and inflation is more or less under control. You say cautiously optimistic. What would make you less optimistic? Is there a particular number or data point that you're looking at that would cause some concern for you?
Sure. So if the overall, so on the individual side, right, for the individual consumer, I would say that that sort of 0.1 is the overall debt on credit cards. I have been eyeing that lately, and it is increasing pretty much every single month. And then adding on to that, 0.2 on the individual side is if the rate of default or even late payments increases, I would be less optimistic. And on the corporate side, I mean, there are any number of external factors sort of weighing or or proving a positive influence on those earnings. So it's a bit hard to say overall, but I would take each corporate story on its own individual merits right now.
Some people say that the price earnings ratio, which some traders use as a gauge, is about between 5 and 10% more than what the average was over the past 10 or 15 years. And some say the market's overvalued. In other words, investors have already priced in all this supposedly good news that we're supposed to get into the future. And that makes me worry a little bit, because if you look at where bond yields are, I saw one today from New York. It was a 30-year bond, roughly 4.3%, tax-free. So if you take the tax rate in New York, that's about 9% or a little bit more, for taking essentially nearly zero risk, right? Why should people pile into the stock market right here, right now?
I would say that I never am an advocate of, air quotes here, piling into anything. But I would say that overall, right, there is this expectation that going forward, either now via a pause or actual cuts coming in the near term, that rates are going to drop off their current highs. And so in that context, and also with the U.S. outperforming pretty much every other major economic bloc in the world, there is this positive inflow of U.S. dollars and external international funds into U.S. equities, but also noting that the U.S. returns and that artificially high PE ratio is being driven by a really handful of names, primarily in the high-tech areas.
Right, I think we know the names that we're talking about. You mentioned international. We had news from the White House about this restriction about U.S. companies investing into specific industries in China because of security reasons. We know, of course, it's related to AI and so some of the chip stuff. This ban, if you will, or a restriction, do you think it's going to have much of a lasting impact? I mean, what I heard was that it was already watered down. It was supposed to be much, I guess, stiffer, and it was, I guess, narrowed.
Yeah, and so any ban or any ban put forward really has to be analyzed into how it's actually, one, implemented, and two, enforced, right? And a big part of these arguments right now over chips linked to AI, which is going to dominate every economic conversation for at least the next 10 years. It's really important to note that almost all of those chips are sort of a dual use tool for, obviously, AI for all of us to use, and also AI for military tools. So I would really want to watch as to what companies are granted a workaround in these bans as they are implemented.
Right, and by the way, for our viewers watching, it's not a done deal. It's proposed. No. They're going to go into I believe, a comment period where the public can comment, and that's, of course, where the companies can ask for an exemption. Sean Stein Smith, over at City University of New York. Good to see you, my friend, and have yourself a good weekend. Thank you.
Thanks, you too.